we're going to start with risk assessment, and then we'll talk about internal controls which help us address the risks, reduce risk. Now, what's risk? Risk is the exposure to circumstances that may increase the likelihood of loss. Now, let's try to quantify risk by using a formula. So, we could use this formula for risk. So, we could say that risk is equal to the probability of a threat to occur multiplied by the probability of the failure of controls. So I told you, right, controls, they help to reduce risk, but if those controls fail, that increases risk. So multiplied by the dollar amount of loss. So guys, think about it. If the probability of the threat is 0, what happens to risk? Risk becomes 0. It's a product. But let us say the probability of the threat is high, then the risk increases. But controls are very strong. They do not fail, such that the probability of the failure of controls, let's say, is 0. What's risk? Risk is 0. Even though the probability of the threat is high, if the controls are strong, they help in reducing risk. So if it's not 0, let's say it's very low, naturally it'll pull down risk, make it very low. So we can use this formula to calculate risk, do our risk assessment. Now, as we move on, we're going to talk about audit risk. So guys, now these are financial statements. Now these financial statements, they are prepared by an entity's management. So management first does its risk assessment because they want to have the right numbers in here. So that's the risk from the management's perspective. Now when management, they prepare the financial statements, you have auditors, independent auditors coming from outside. Guys, I said management, they prepare the financial statements. So naturally, they are responsible for these numbers. Now, auditors, the independent auditors who come in from outside, they look at these numbers, they do an audit around these numbers and express an opinion on them. So since management, they're preparing the financials, they're responsible for the financial statements. The auditors who express an opinion on these numbers are responsible for their opinion on these financial statements. Now, the reason why we have auditors come and express their opinion is to add credibility to these financials. Because think about it, management, they are preparing the financial statements, and these financial statements are a reflection of their own performance. So it's something like, it's a financial scorecard of the management prepared by the management, and that is why the auditors come in, express an opinion, and that adds credibility to these numbers. Management responsible for the financial statements, auditors responsible for their opinion on these numbers. Now, the risk for the management is that they have wrong numbers coming on these financial statements. They would be responsible for that. Risk for the auditors is that they express a wrong opinion on these numbers. Something like they express a clean and unqualified opinion on materially misstated financial statements. So guys, risk from the management's perspective, they want to have the right numbers. Risk from the auditor's perspective, they want to give the right opinion. Then we'll move on and we'll talk about internal controls. So I told you, management, they are responsible for the financial statements. Now management, they are also responsible for the internal controls that they have which create these financials. And under the provisions of the Sarbanes-Oxley Act, which was passed in 2002, auditors who come in not only look at these financials, they also look at the internal controls over financial reporting. And auditors under SOX, and this is auditors for public companies, issuers, they come in, they express two opinions. So they do two audits, audit of financials and audit of internal controls, and they express two opinions. First opinion on the financial statements, second opinion on internal controls over financial reporting, and that is called integrated audit. So guys, as you can understand, SOX, it placed a lot of emphasis over internal controls. So management responsible for financials, responsible for internal controls. Auditors responsible for the opinion on the financials as well as the opinion on internal controls which create these statements. Now, as you can understand, the concept of audit risk, concept of internal controls, the provisions of the Sarbanes-Oxley Act. Now, these are topics which are dealt with in a lot of detail with a lot of focus on the auditing part of the CPA exams. So what I'm going to do here is I'm going to get the CPA audit instructor who's going to teach you these topics from an auditor's perspective. So let's first get to the book, look at a little bit of this risk and the risk formula I gave to you, and we're going to come back, look at audit risk, talk about internal controls, and wind up with the Sarbanes-Oxley Act of 2002. We're looking at risk, and let's look at that formula for quantifying risk. Highlight risk equals probability of the threat multiplied by the probability of the failure of controls multiplied by the amount of loss. So the probability of threat, draw an arrow there and write threat. Probability of failure of controls, draw an arrow, write failure of control. Next, highlight the design of controls. Now, they should be driven by highlight risk assessments. So you could go on top of this page and write risk assessment by management. Because in the next few pages, we're going to talk about the risk assessment by auditors. So the independent auditors who come in from outside do the audit on the financial statements. Now, when we're doing risk assessment by management, we're looking at controls which should be established to limit the risk of a potential underlying loss of assets or underlying misstatements of material information. Next, we got put a box around managing risk. So we looked at the formula for risk where we said risk increases by increase in threat, increase in failure of controls. So a good way of managing risk would be preventing highlight threats or increasing highlight controls. Coming down on the page, you got put a box around factors that affect risk. Now, a variety of factors affect risk, including the frequency of independent checks on performance, adequacy of organizational control methods, adequacy of communication of authority and responsibility, the consistency of enforcements of controls, and adequacy of system controls that limit access to or physical control of assets, records, software, or data. Now, we didn't do any risk assessment procedures back then, but it was just a preliminary assessment. This preliminary assessment could be based on our prior experience with the client. If it's a new client, maybe based on the documentation that we could see from predecessor auditors. Now guys, it's very important for us to understand the concept of audit risk. Audit risk is the risk that we, the auditors, issue a wrong opinion on these financials. So guys, remember, management is responsible for the financial statements. We as auditors, we are responsible for our opinion on these financial statements. And if we issue a wrong opinion, that's the audit risk. That's our worry. That's the risk that we give a clean opinion on materially misstated financials. It's something like what Arthur Andersen did for Enron. So Enron had cooked up financials. They had materially misstated financials. But Arthur Andersen signed off on that. They gave a clean opinion. That's audit risk. Guys, this is the risk that gives you sleepless nights as auditors. It keeps you tossing and turning in bed. So, audit risk consists of three elements. So, you have audit risk or AR, which is equal to IR, or inherent risk into CR, that's control risk, into DR, this one's detection risk. So IR or inherent risk is the risk inherent, assuming no internal controls exist. It's how susceptible is the element to risk. Let's say I got $1 million in hard cash. I keep it on this table right here. I go out of the door, keep the door open, come back the next day. Will I find the $1 million out here? I don't think so. How about the tables? Will anybody take these tables away? No. This is because cash, the hard cash, that's got high susceptibility to risk. Nobody's taking the furniture. That's low inherent risk. But cash, high inherent risk. Let's take an example of a diamond merchant. So he's got a lot of diamonds across his shop. There's a big risk that somebody might just pocket those diamonds and walk away. That's inherent risk. The diamonds in his shop, they've got high inherent risk. They are highly susceptible to risk. The next one, CR, this is control risk. So I told you the client has got internal controls that create the financials. Now control risk is a risk that the client's internal controls will fail to detect the material misstatement. So that's a breakdown of the client's internal controls. So let's say our dear diamond merchant, he's got all the diamonds which have got high inherent risk. So he puts in a lot of security guards to guard the diamonds. Now how about the staff in the shop colluding with the security staff and stealing the diamonds? That's a failure of internal controls. That is control risk. So guys, inherent risk is susceptibility to risk. Control risk is the failure of internal controls. It's the risk that the client's internal controls will fail to detect the material misstatement. Now, as an auditor, we do not have control over inherent risk or control risk. We only assess them. We assess how much of inherent risk does the client have in his business. So let's say if the client is doing a business which is totally based on cash sales and cash purchases, that's high inherent risk. Cash, high inherent risk. Let's say the client is a diamond merchant, high inherent risk, a lot of diamonds, a lot of inherent risk. CR is control risk. Now guys, I told you, management is responsible for financials, we are responsible for our opinion on the financials. Management is responsible for internal controls, we only assess the internal controls. So management puts the internal control in place and we assess what is the control risk. What is the risk that those internal controls which have been placed by the management will miss a material misstatement. Now we come to the last element of audit risk. This is detection risk. This is the risk that we the auditors, we will fail to detect a material misstatement. Either we've taken a bad audit sample or we've done a bad job as an auditor, but we have failed to detect a material misstatement on these financials. We've given a clean opinion, we failed to detect it. Guys, this is very important. So if you realize, let's say the client's internal control misses a material misstatement and it's there on the financials. But we as auditors, we detect that misstatement. We give them an audit adjustment. We ask them to change it off because we have detected it. Will the financials still be materially misstated? No, because we have detected it. We've caught the loophole. How about, let's say, the client's internal controls are very strong. So the client's internal control, that does not miss any material misstatement. So you've got every issue, the internal controls take care of that. The financials that the client gives to us, that's all fair. It does not have a single material misstatement. Even if we don't do a good job as auditors, the financials, they are good. So guys, now I hope you're understanding. If we can keep any of these components to very low, we can reduce our audit risk. So let's say if control risk is 0, that means the client has got perfect internal controls. Will there be material misstatements here? No. So we've got no audit risk. Let's say control risk is high, that is the client's internal controls aren't so good. But we do a great job as auditors. We don't miss out anything. We do a very wonderful job. So our detection risk is 0. The risk that we will miss a material misstatement, that's, as I said, 0. In that case, what's audit risk? 0. So guys, to keep audit risk at a low level, we have to make sure that either of them, okay, if it's not zero, it should be at a low level. If the client's internal controls are good, then we can afford to have a higher detection risk. So if client's internal controls are good, that means control risk is low. We can afford to have a higher detection risk. Guys, you're understanding this, right? This is a product. So if this is low, to keep the same level of audit risk, we can afford to have a higher detection risk. But if the client's internal controls are bad and control risk is high, to minimize our audit risk, we have to keep the detection risk low. That means we have to do more work. We cannot afford to miss a material misstatement. Now, we'll talk about in detail when we're doing substantive tests. That substantive tests contain test of details as well as analytical procedures which help us understand what our detection risk is. Now, as I told you, as auditors, we assess inherent risk, we assess control risk. Detection risk is something that we determine. So guys, if we do more work, if we work really hard as auditors, our detection risk, that's low. If we do less work, detection risk is high, because the more the work we'll do, the lesser the probability that we will miss a material misstatement. Now, you have IR into CR is something that we assess. Now, IR into CR or inherent risk into control risk is also called the risk of material misstatement or RMM. This is the RMM that you have here, risk of material misstatement. This is something that we see, we assess. DR is something we determine. So audit risk is IR into CR into DR, or you could say audit risk is RMM into DR. Now I've talked about controls. Let me just try to put it on the board here. So let us say that the client's internal controls are strong. The reliance on internal controls, you would say it's got good internal controls. So you want to rely on internal controls. There's strong internal controls. What happens to control risk? If internal controls are strong, how much is the risk that the client's internal control will fail to detect a material misstatement? So if it's strong internal controls, they will detect all material misstatements. The control risk, that'll be low. So if internal controls, let's say, if internal controls is strong, then control risk, that's low. If control risk is low, that means the client's internal controls are so strong. Do you really want to put a lot of audit work there? You would say control risk is low. How about I afford a higher detection risk? The audit risk could be at the same level. So if you reduce this, you can afford to increase your detection risk. So you would say if control risk is low, you can have a higher level of detection risk. Higher level of detection risk means you can afford to have a risk that you would miss a material misstatement. That means you would do less work, so less substantive testing. So guys, this is very, very, very important. So I hope you're understanding this. If internal controls are strong, control risk is low. If control risk is low, we can afford to have a higher detection risk. That means we can do less work as auditors. Let's change the scenario. How about, let's say, internal controls are pathetic. The client has got very bad internal controls. What happens then? What happens to control risk? Yeah, exactly. The control risk increases. So as auditor, what do you need to do with the detection risk? If control risk is high, what do you do with the detection risk? Lower it. Exactly. So if control risk is high, you would want to keep a low level of detection risk. If the client's internal controls are bad, they will have all cooked up financials here. The financials will be totally materially misstated. Then you as an auditor, you cannot miss the material misstatement. You have to see everything out here. You have to keep a low level of detection risk, and you got to work days and nights. You got to work 150 hours a week to find all the errors there. So your substantive tests increases. So guys, these relationships, they are very important. Trust me, if you know these well, you can do a lot of questions on the CPA exam. Important thing to understand, if internal controls are good, control risk is low. If internal controls are bad, control risk is high. If control risk is low, we can afford a higher detection risk. If control risk is high, we need to have a lower detection risk, guys. Otherwise, our audit risk is going to increase. Think about it. If control risk is increasing, our audit risk will increase. How do we control the audit risk? By lowering detection risk. So that is what we do. If control risk is high, we lower detection risk. Higher detection risk means less work. We have a good time out there. Lower detection risk means lot of work. As I told you, 150 hours per week. So guys, this is the concept of audit risk and very important. Okay, let me also talk a bit about materiality here. So let us say we have a particular account balance. Let's say the account balance is of $1 million, 1 million. And let us say something that we think is material to this account balance, let's say its accounts receivable is $5,000. So we say that anything below $5,000, that is immaterial, doesn't matter. Anything above $5,000, that is material to $1 million. Now, if audit risk is high, if there is a high risk that there may be material misstatements, what do? We might want to do more work. We might want to do more substantive testing. In that case, we would reduce the level of materiality. We would say not $5,000, but $2,000 is the level of materiality. We'll do more work. Remember, when this $5,000 was a level of materiality, we said this is the scope of our audit, for which we give a reasonable assurance. If we find audit risk to be high, then we'll increase the scope of our audit. We will lower materiality and increase the scope. So guys, audit risk and materiality are inversely related. If audit risk increases, materiality decreases. That means you end up doing more work. So instead of doing so much work, $5,000 to $1 million, you do work from $2,000 to $1 million. So your scope increases, your work increases. As audit risk increased, you lowered materiality. How about we say audit risk is pretty low, the client's doing a good job, they've got strong internal controls. The internal controls will not miss out a single material misstatement. In that case, we can increase the level of materiality. Instead of saying $5,000, we can say $10,000 and our work would reduce. So guys, this is the concept that we're talking about here. Very important for you to understand. Now, this is not exactly a part of planning, but I gave to you right here in planning so that you're very thorough with these concepts when you come to it in audit 3. In audit 3, when we're doing internal controls, that's when we'll deal with control risk. In audit 4, when you're talking about substantive testing, that's where you have detection risk. So the audit risk model is all you'll have for the next few days. Guys, it's going to be a lot of fun, and trust me, this is very important. We're looking at audit risk. So on top of the page, write risk assessment by auditor, within brackets, audit risk. And right there, risk that the auditor will give a wrong opinion, underline wrong. That means the auditor would issue unqualified opinion on materially misstated financial statements. Now, audit risk includes components of highlight inherent risk, right there, that's errors inherent in the nature of business. Highlight control risk, which means that client's internal controls misses the error. And highlight detection risk, auditor misses the error. So we know that audit risk is inherent risk multiplied by control risk multiplied by detection risk. Turn to page 6, and on the space that we have on the second half of the page, let's write the audit risk formula. Audit risk equals IR into CR into DR. And for IR and CR, draw a bracket and write RMM, that's the risk of material misstatement. And we know that RMM is equal to IR into CR. So in other words, right, audit risk or AR equals RMM into DR. Now we know that for inherent risk or control risk, that's a risk of material misstatement, the auditor only assesses. But detection risk, that's the risk that the auditor determines. So right there, therefore DR equals audit risk divided by risk of material misstatement. That's AR divided by RMM, which is also equal to, right, AR divided by IR into CR. So we could say that detection risk is inversely proportional to RMM. So as RMM or IR and CR increase, the detection risk needs to decrease. And let's put our interpretations on here. Right, if internal controls are good, what happens? Right, reliance on internal controls, that goes up, which means that the risk that the client's internal controls would miss an error, that reduces. All right, CR goes down, which implies that the auditor can afford, right, higher DR and he can do less work. So right, less substantive tests. Right, there implies number one, if CR is low, the auditor may raise DR so that AR is unaffected. So if the control risk is low, the auditor can afford to have a higher detection risk without increasing the audit risk. Right, number two, good internal controls, that means that, right, less work is required by the auditor. So we've seen that what happens when internal controls, they're good. Now let's talk about what happens when internal controls are bad. So right, if internal controls are bad, the reliance on internal control, that goes down. That means there's a higher risk that internal controls, they would miss errors. Alright, control risk goes up. Now this means that the auditor needs to reduce detection risk. He needs to reduce the risk that he would miss a material error. So right there, DR goes down, which means the auditor needs to work harder. So right, substantive tests, they need to go up. Let's see the implications here, right? Implies number one, if CR or control risk is high, the auditor needs to decrease DR, right? So that AR is unaffected. And number two, right, bad internal controls. Now that means, right, more work by the auditor because he needs to reduce detection risk.